I think the thing that's really interesting about what we see in China is experiencing a deflationary slump. And that deflationary slump is something that, plenty of economies have experienced through time. The solution to a deflationary slump is relatively straightforward, which is significant monetary and fiscal easing in order to re-stimulate the economy. And nonetheless, what you've seen is that policymakers, and particularly the PBOC, but also the central government, have chosen not to engage in that stimulation. And so what you see here is a very classic set of intermarket action, which I think is very interesting, which is stocks are falling and basically have been at their lows of the last 15 years, basically at 15-year, at the same price level as they were 15 years ago. Bond yields are falling to the lowest level that they've seen in 15 years. All of that is deflationary slump dynamics. And yet, in an economy where the debt is in their local currency, they have a fair amount of flexibility from a government perspective to stimulate fiscally. They have a fair amount of ability to stimulate on a monetary basis. And so they're just not doing it. It's not a matter, their conditions are not a matter of circumstance. They're a matter of choice. And I think if you go under the hood and look at some of the dynamics that are going on, there's really been a centralization, a political centralization, in particular on the monetary side of the PBOC, historically, which had been driven by technocrats, Western educated technocrats who were implementing monetary policy in a way that was maybe not exactly consistent with, but informed by historical Western monetary policy approaches and tactics. Nearly all those people have been removed from the PBOC, quit, or been shuffled out, and instead political appointees have been put in place. And so what we're seeing here is a set of choices to run a weaker economy. I won't opine on the exact reasons why. That's above my pay grade in terms of the geopolitical decisions that are going on there. But certainly from a perspective of a macroeconomy view, what we're seeing is really a real prioritization of the exchange rate relative to domestic growth circumstances. Part of that's driven by the fact that there's been such a significant pullback in capital in China that there's an underlying weak set of conditions for the exchange rate. And part of it is driven by focus that exchange rate stability appears to be a primary goal above domestic stimulation. The reason why that is typically what you do in this circumstance is you'd ease. That easing would lower your currency, which would be stimulative, and support your stock market, and they're choosing not to do that. And if anything, you can even see their policy is highly responsive to exactly what's going on with the exchange rate. So they provide a little bit more liquidity when the exchange rate stabilizes, and they highly tighten liquidity domestically when the exchange rate is facing downward pressure. And so China in many ways looks like an economy that is stuck. And a lot of those hopes that I think had been dashed several times over in 2023. I think it's starting, it's time to recognize that from a global macroeconomic standpoint, probably not worth expecting that China is going to experience a significant acceleration in any way. That may change. We'll keep an eye on the markets, particularly the stock and bond market dynamics, but unlikely to change in the future.